Today's Lucid stock analysis is going to talk about Lucid's biggest problem. Now, we like to keep things very simple here at Nanalyze because we're simple people, and we like to control risk. That's because we're risk-averse tech investors. So let's start with a question that they ask in business school and just about every business strategy class. They'll say, what's the ultimate goal of every business? You'll get all kinds of answers. It's to generate a profit, or it's to go public, or it's to reward its shareholders or benefit the community. None of those are true. The ultimate goal of every business is to simply survive. And you see this a lot in the stock market when you start looking at companies that don't have traction and continue trying to raise revenues. You can see how desperately they try to cling to hope and get other people to believe in their business as they try to pivot every which way until they have a business that can ultimately generate profits. Now, when we're looking at survivability, there's one metric we pay very close attention to, and we're going to demonstrate that here with a simple example of Johnny's lemonade stand. So there's a term in accounting called COGS. It's an acronym for this statement here, cost of goods sold. It's very simple. Let's take the lemonade stand example. So if you're going to run a lemonade stand, you need to buy the goods that you're going to transform into something of value and sell to people. So you have some sugar, some lemons, and let's say 30 cups. So you spend $30 on the cost of the goods that you're going to sell. Now you mix up the sugar, lemons, and water, and you start selling cups of lemonade. What can you sell them for? Well, let's say you could sell them for 75 cents and you receive $22.50 in return. That's not a business. So when you produce something that you have to sell for less than it costs to produce, that's not a business. So that's very critically important. They call this gross margin. So the difference between cost of goods sold and revenues is gross margin. So if you can sell those 30 cups of lemonade for $1 a piece, well, you broke even. That's still not a business because you're not able to generate profits. If you can sell them for $1.50, then you see here, well, we have $15 left over, so we have a gross margin of roughly 50%. Now, with the profit that's generated, we then need to pay overhead. So things like marketing or human resources, or what they refer to as general and administrative expenses. The key takeaway here is you cannot sell a product for less than it costs to produce because that's not a business. So let's talk about Lucid's profitability problem. People will be quick to say, well, you always talk about not focusing on profits and focusing on revenue growth. Correct. However, the profit number that we pay very close attention to for any business is gross profit. So you can see here that operating income for Lucid, the bottom line there, okay, they're losing a bunch of money. That's expected. You expect firms that are trying to grow as quickly as possible and capture market share to be losing money. However, you expect them to be producing a product and selling it for more than it costs to produce. Look here at the income statement from Lucid, which shows their gross profit. You can see that's negative. So if one way to look at it is this, if we start on the right-hand side, the red numbers there at the bottom expressed as a percent, this is the percentage of money that Lucid is able to recoup from the cost of the goods that they're selling. So 23%. Well, that's not very good. If you spend $1 and you receive 23 cents back, that's not good. But look how moving to the left, it starts increasing. Ideally, you want that to go over 100% so that you have a business, and you can see it's slowly increasing. That number on the far left there at the bottom, 37%, that's trailing 12 months. So for all practical purposes, that's the entire year of 2022. They recouped 37% of the money that they spent producing cars. So they really need to accelerate that. Now, people are always quick to say, well, but what about Tesla? Okay, fair enough. Let's look at Tesla. So the nice thing about SEC documents is you can go back in time and look at what companies, their financial picture looked like many years back. So here you can see Tesla's basic numbers from 2009 to 2013. And look along the bottom there, you see a net loss. So the 5 years following their IPO, they lost close to $1 billion. Fair enough, but we're looking at the wrong number. We expect there to be a net loss. The number that we want to look at here is Tesla's gross profit. This is rather interesting. Look along the bottom there. So we've highlighted the numbers that you need to pay attention to. The total revenues that Tesla was generating from selling cars and the total cost of producing those cars. And look along the bottom there. They've had a positive gross profit ever since they had their IPO. Here's another example. We look at Polestar. So this is another firm that we've covered. By the way, we've written research pieces on most of these companies, and I'll put the links to those in the description of this video, the ones that are relevant. So here's just a picture of Polestar's basic revenue and cost of goods sold. Look at how tight that is. So that's a whole lot better than Lucid. It's not optimal because that's a pretty tight gross margin there, and your margin for error is quite low. So investors like to see a healthy gross margin, which gives you some buffer. So Polestar's looking a whole lot better than Lucid is. Now, the last time we looked at Lucid was back in November of 2021, and at that time, you can see the stock chart here on the lower left, it was $51 a share. Today, it's floating, somewhere around $9 a share. At that time, we were pointing out how overvalued it was, so it blew past Ford in market cap, even briefly surpassed General Motors in value. These are firms that produced over $120 billion in revenues, and somehow Lucid is valued the same as they are. That doesn't sound right. Intuitively, doesn't make any sense. Now, the lower right here, you can see their quarterly revenues, how they've started to produce some revenues, and you can also see their losses as well. Now, at that time, we noted the company's current manufacturing facilities were designed, or are designed at the time, to produce up to 34,000 vehicles annually. Great. So how is that going? As you know, economies of scale means that the more cars that you produce, the cheaper they become, the more you can spread out fixed costs. So intuitively, cost of goods sold will decrease as your company scales. That's what everybody's hoping for with Lucid, right? So we look at the results. In 2022, the company produced 7,180 vehicles, exceeding provided guidance range of 6,000 to 7,000 vehicles. There's two things to note here right away. First of all, produced versus delivered are entirely different metrics. So delivered assumes sold 4,369 vehicles. But forget about that for a second. Let's focus on the number of vehicles produced. Look at this statement taken from a Verge article last summer. Lucid originally said it would make 20,000 vehicles in 2022, but that number was revised in February to 12,000 to 14,000, and of course revised all the way down to 6,000 to 7,000. So having the cojones to say that you beat your guidance is that's a pretty bold move there, because anyone that can look backwards in the least amount of effort will see that this company hasn't been able to meet expectations at all. So we look here from a Reuters piece yesterday. It says, Lucid said it expects to produce 10,000 to 14,000 luxury electric vehicles this year. Again, not sell, simply produce. And the market was upset because analysts had expected Lucid to make 21,815 cars. Let's take a look again at the Tesla benchmark here. You can see this is not vehicles produced, this is vehicles delivered. And look how quickly Tesla starts scaling their business from 2,600 vehicles delivered to 22,400 vehicles delivered. In other words, once they made that investment in infrastructure, they were able to scale quite rapidly. And that comes down to competency in your ability to manufacture things at scale, which Tesla would say, well, it's a result of our automation, which they consider to be one of their greatest competitive advantages. Look here at what Lucid said they were going to do. And you need to be very critical of company management teams that miss their grand expectations by this much. So in 2022, Lucid was said they were going to, on their SPAC deck, produce over 20,000 vehicles. Well, that clearly didn't happen. We were supposed to see $2.2 billion in revenues and a small gross profit. So for this year, the year we're in now, They said they were going to produce nearly 49,000 vehicles, $5.5 billion of revenues, and $1.15 billion of gross profit. Doesn't look like that's going to happen based on the trajectory. Now, the one thing that Lucid does have going for it, as does every other company out there that just needs to blow the hell out of their cash stockpile and keep raising money and selling that story, is that they have some very deep pockets that they've been able to avail themselves of. So if you're not familiar with this notion of sovereign wealth funds in finance, these people are very important because they command a lot of money. So you'll see asset managers desperately courting these individuals, trying to get their fingers on some of this cash. So the world's biggest sovereign wealth fund is out of Norway, surprisingly, all their oil money. And then you see going down the list here, 3 of the top 5 are in the Middle East. You have Kuwait, Abu Dhabi, and Saudis here at the bottom. Their public investment fund, which grew from $152 billion at the end of 2015 to $620 billion, where it sits today. These numbers are taken from the Sovereign Wealth Fund Institute. And since the launch of Saudi Vision 2030 in 2016, this is where they decided to get rid of the curse of oil, which even Azerbaijan has that problem, or some other countries that rely heavily on the production of oil for their income. They wanted to diversify away from that, and the Saudi Vision 2030 is their plan to do that. So when you look at, I'm actually in Qatar at the moment, and on the television, I keep seeing these television adverts from the Public Investment Fund about this beautiful building here. You see New Murabba. This is in Riyadh. They're building the world's largest modern downtown. It's adding over 19 square kilometers to the city of Riyadh. I don't know what that is in miles, but you can see this is a huge undertaking, somewhere around $48 billion that's going into this project with an emphasis on sustainability. So there's going to be featuring green areas and walking and cycling paths, and they're really focused on the green elements. They're going to have giant holograms, and it's all quite spectacular, and that's all part of their investing in the growth of tourism. And when you look at the sort of investments that the Saudis make when it comes to startups, you could see here, well, there's Lucid Motors. So they invested heavily in a number of names that require a ton of cash. You have Magic Leap. Of course, SoftBank courted the Saudis quite a bit. Babylon Health, that's a business that we've written about, which doesn't look very good, frankly. And the rumor is then that the Saudis are going to buy their remaining stake in Lucid, and shares of the stock surged on that report. So you really shouldn't pay attention to speculations, and I guess that would be one thing that Lucid has going for it, is they have access to very deep pockets and interest from the Saudis, who are looking to spend just tons and tons of cash on building this tourism ecosystem and infrastructure throughout their country. So perhaps they're looking at Lucid as a way to build out the electric vehicle component of that city. Who knows? It's all speculation, and you really shouldn't pay much attention to speculation. You should pay attention to the company that you're invested in, which doesn't have a business right now. So in our last piece, the researcher had written, everywhere is within walking distance if you have the time. Given enough time and money, perhaps Lucid Motors will be able to produce enough cars and realize profitability. That we would say the same exact thing today. So investors in Lucid stock should pay very close attention to gross margin. So we always avoid companies with a negative gross margin. So another example would be Plug Power. We're just not interested in investing in companies that have a negative gross margin. We'll check back when it turns positive, and it's maintained some positivity over time. So Fluence Energy would be another example of a company that's just starting to see a positive gross margin. You don't just want to see that one-time event. You want to see some sustainability and continued trend of a positive gross margin. So Lucid's COGS trend is positive, but their burn is very concerning, and the company certainly isn't scaling as fast as they should, nowhere near what they promised investors, which is a red flag in itself. So I've put up another video here on the fallacy of trying to find the next Tesla, but before you watch that video, please click the logo here on the right, the Nanalyze logo, subscribe to our channel. Thanks so much for taking the time to watch this today.